Professional Traders. Courses of the Master of Professional Trading. Master 2019. Course 1. History of the Market. Welcome to the course. Welcome to this Master of Professional Trading. This master is composed of 20 professional trading courses, aimed at new traders. My name is Jesus. I am one of the avatars professors of professional traders. And it is a great pleasure for me to be here with all of you today. I am going to explain to you the concepts that you need to know to become a professional traders, and that you can live from this fantastic profession. Today we are going to present the first course of the Professional Trading Master. History of the Market. This course is aimed at those who want to enter in the exciting world of trading. I will explain you the concepts that you need to know about the history of the market to become professional trader, and that you can live from this fantastic profession. There are many people in the world who choose this exciting profession as a way of life. However, only few are those who achieve it. The development of information technology has allowed access to the markets of many professionals, who previously could only access through brokers or specialized companies. The development of any profession requires learning. And becoming a professional requires a long way. Becoming a consistent trader is not something that is achieved in a couple of months. It requires perseverance and study. The first step, you have already given. Now awaits you an exciting path, that we will travel with you, until you reach the consistency. Presentation of the course. With this course, we want to demystify the shadow that exists in Europe over the trading. In the United States, millions of new traders access the trading process every year. However, in Europe the number of new traders is very small. The object of this course is to teach you from the first day how to operate in the market and habituate your mind, step by step, to adapt to this process. Imagine a soccer match in which you decide when the game starts and when it ends. Well, this is how trading works. Let's see the similarity. Suppose you have decided to start the game at this time. This means that you have opened a position in the market. After 15 minutes you score a goal. This means that your position in the market is green, that is, you earn money. Now you decide that the game is over, and therefore you are winner. This is equivalent to closing the position in the market and collecting profits. Trading consists of buy a stock in the market at a level price, to later sell it at a higher level price, and obtaining a profit. This buy operation is also called long. Similarly, the trading consists of sell a stock at a level price, and then buy it at a lower level and obtaining a profit. This sell operation is also called short operation. The consistent trading process is intended for the trader to earn money, and do not lose more money than he wins. For achieve this goal, the trader must be consistent. That is why the fundamental purpose of this course is to follow this path, that it will allow us, at the end of it, to obtain the consistency. Consistency means that the balance of our trading account is always positive. That is to say, that the profit of our winning operations is superior to the loss of our losing operations. It is the same process as that carried out by any company that develops its activity through purchases and sales of products. Imagine the activity of a supermarket or a department store. Of all the products that they buy, the supermarket increases the purchase price and tries to sell the product at that new price. However, some products do not sell it, and they need to sell them below the purchase price. At the end of each period, that can be monthly, quarterly, etc., the supermarket will count its profit by subtracting the losses from the profits. If the benefit is positive, we can say that the system of purchase and sale is consistent. If the supermarket loses more than it wins, then we will say that its purchase and sales system is not consistent. The objective of the professional trader is to be consistent. And to be consistent, the first thing we must learn is follow the trend. A consistent trader does not consider whether a price is high or low in its trading process. He simply does what the market does. He always operates together with its tendency. If the market goes up, buy. If the market goes down, sell. Therefore, we have thought that the best way to introduce you to the world of professional trading is through the history of the market. Remember, the knowledge of history will allow us not to make the same mistakes that others have done previously. What is the market? The market, in economics, is any set of process transactions or exchange of goods or services between individuals. The market does not refer directly to profit, or to companies, but simply to mutual agreement in the context of transactions. These can have as participants individuals, companies, cooperatives, NGO, etc. The market is the social, or virtual, environment that propitiates the conditions for exchange. In other words, it must be interpreted as the institution or social organization through which the bidders, producers, sellers, and applicants, consumers or buyers, of a certain type of good or service, enter into close commercial relations, in order to perform commercial transactions. The market exists since the dawn of humanity. We all need something that we do not have, that someone else has, and we are willing to pay a price to get it. When we buy a stock in the market, it is because someone is willing to sell it. The market is just as blind. He does not pay attention to what we do, he does not watch us, he does not go against us. This is often the excuse of many inconsistent traders who suspect that the market watches over them, and does the opposite of what they do. The market does not decide the price, it is decided by millions of traders in a specific time frame. The market reflects at every moment the battle between the bullish and bearish. The market is not our enemy, we are the ones who are not condescending with him, we behave in an irrational way at times, and let ourselves be carried away by emotions. Remember, only we are responsible for our actions. How does the market work? The definition of market according to marketing, is the set of organizations or individuals with needs or desires that have capacity, and that have the will to buy goods and services to meet their needs. However, this definition does not clearly represent what the market is, and how it actually works. The market is an achievement and interrelation of economic cycles that have as a consequence that the price of a certain stock moves between a maximum value and a minimum value. When these movements of the price are exaggeratedly great both in the bullish branch and in the bearish branch, characterized by an absence of significant pullbacks in the movement of the price, and creating an exceptional maximum compared with the rest of the historical cycles of the stock, it is when we call the movement an economic bubble movement. Once the value has reached that exceptional maximum, the movement of the stock price changes rapidly from bullish to bearish direction and falls sharply in a very short period of time. How is a bubble created and exploded? The economic bubbles need the following factors in order to be created. Create an illusion. Sell the illusion correctly. Create a need in the mass. That the mass buys the illusion. Once the bubble is created, the problem for the investing mass appears when the bubble reaches its maximum value. Let's analyze below all the phases of formation and bursting of an economic bubble. Create an illusion. Every day of our lives, from the time we wake up until we go to sleep, we are surfing economic bubbles and face their effects and consequences without knowing it. The creator of the bubble analyzes the market, and looks for new elements and assets that may be capable of generating a bubble. Once you have analyzed these, and established the asset creates an illusion around it. A clear example today can be cryptocurrencies. Cryptocurrencies are virtual currencies. They can be exchanged and operated like any other traditional currency, but they are beyond the control of governments and financial institutions. Sell the illusion correctly. The creator of the bubble uses the different mass medias, so that the created illusion can reach the public. And it systematically bombards the public, focusing its message primarily on potential customers. And for this purpose, they build a discourse based on what their investors want to hear, and not on the reality of the idea. That is to say, they create a mirage, or fiction in those who are easier to convince, and who will acquire the illusion more certain, that the illusion is the business of their life, and that they cannot let it escape under any circumstances. To understand this principle, it is enough to put the example of the teleshopping phenomenon. How many people buy gym equipment for lose weight, or wonderful and fantastic kitchen utensils, etc., which then uses 2 days, and end up in the attic? The effect that is created through telemarketing is an effect of necessity in the mass. So much so that many people think, how have I been able to live without these devices? I need to buy them immediately. The illusion created by the seller of telemarketing is that the investor in the product, the buyer in this case, will have a better life with these devices. You will eat healthier, you will live more years, you will lose weight, and ultimately you will be happier in your life. That's the kind of information that potential customers want to hear and not reality. Create a need in the mass. Once the illusion is correctly sold, the creator of the illusion only must wait for the seed of the sale of the illusion to germinate in the brain of the mass, generating in each participating individual a need. The better the idea has been sold, the greater the force of necessity in the mass. Therefore, the creator of the illusion in this phase only has to finish his work, by means of the disclosure in the media of the appropriate phrases such as, "If you buy this stock, it will change your life. It's time to invest." This is a unique opportunity that will change your way of life. Or only a few can benefit from this exceptional offer. After this phase, the feelings of need grow exponentially, and the mass is already convinced, and willing to invest in the illusion. That the mass buys the illusion. In this phase, the creator of the bubble will make the stock price take a pronounced bullish branch by pumping the price up through buy options at the appropriate times. In this way the investing mass will increase more and more his idea that the business of his life is on the way. Crack of a bubble. An economic bubble, no matter how hard it sounds, it is still the fact of trying to create a reality based on a fiction. Once the bubble is created, it will feed itself by incorporating new investors. The creator of the bubble will wait until the propitious moment to leave it, slowly withdrawing his investments so that the mass does not realize his exit. The mass of investors at this time earn extraordinary benefits, and they do not think that something that has risen continuously and so solidly may fall unexpectedly. What's more, they only think of where to get more money to reinvest in the stock. Some even, they will ask for credits for it, which surpasses any level of irrationality imaginable. When the creator of the bubble or bubble maker is out of stock, because he has sold all his options, then it is time to enter in the stock again, but this time with sell options that he close again each time a support level is reached. The creator of the bubble repeats this process until the price returns to the prior level to the creation of the economic bubble. This action and reaction of the price of a stock is called crack of the bubble. To avoid a bubble there are only two paths. The first one is the obvious one, not entering the market, and the second one is operating exclusively with the tendency. If we open a position in the market, and it does not evolve favorably, we will close it immediately. Example of an economic bubble. In the attached graphs, as an example, we can see how the Ethereum cryptocurrency bubble is created, shaped and exploded. In a succinct way, we will say that, the creator of the bubble generates 5 waves of buy until reaching the maximum value of the stock. From this point, he starts closing all his buy options. The rest of traders are not yet aware of what is going to happen. They think that the value, if it has gone up here, why it will not continue to going up. Subsequently, the bubble maker generates 5 waves of sell until the price reaches the initial level, as we can see in the attached figures. In later courses, we will see that the bubble makers, and the institutional traders, always try to hide the clues that allow us to follow them, entering and leaving the market by levels, and creating this type of waves with the help of the traders' mass. Participants in the market. Market participants ordered according to the size of their account are the following: institutional traders, professional traders, traders. The institutional traders, also called market makers or strong hands, are professional traders who work in institutions, investment funds, etc. The balance of his accounts can vary between 10 million euros to hundreds of millions of euros. Due to the large size of their accounts, they cannot invest their money at once, since they would create an imbalance in the supply and demand. So they buy and sell in stages depending on the levels of support and price resistance. Another very powerful reason to justify this type of operation, is that they are the ones who establish the trend, and they try at all times to hide their traces. They do not want anyone to follow them because their benefits come from traders who do not follow the trend. In addition, the size of their accounts allows them to hold positions much more time than the rest of traders. Using the simile that Jose Luis Carpatos uses in his books, on an animal scale, they would be equivalent to the lions. The professional traders are all those who live exclusively from trading, and who do not belong to the previous group. The balance of his accounts can vary between 50,000 euros and 10 million euros. Not all professional traders are consistent, therefore, within this group of professional traders a small group of consistent professional traders is included. This last group is usually 5% of the number of professional traders. Traders are investors who approach the market without adequate training in search of benefits. Their accounts are small, between 2,000 and 50,000 euros. They are called weak hands, or as Jose Luis Carpatos defines them, gazelles. They are without doubt the food of the lions. These actors are generally characterized by ignorance. Their entries and exits from the market are based on their emotions, on advice from third parties, etc., but never in a consistent trading system. As a summary, we can establish that only 5% of professional traders are consistent. The rest of the traders not included in the institutional group, they lose his money. Although we will study in detail in later courses the most common errors in the trading process, basically the lack of consistency is based on one or more of the following errors. Lack of adequate training. False expectations about the reality of trading. Inconsistency. Inappropriate risk management. Lack or breach of a trading plan. Inadequate trading system. Non-compliance with the rules of entry and exit of the market. Lack of emotional control. Impatience and precipitation. Fear and delay. Nervousness and out-of-control risk. Greed and overacting in the market. Operate in periods with very high volatility. Always remember, only we are responsible for our mistakes, and therefore we must know how to correct them and how to avoid them. For this purpose, you must train your psychology and practice the rules that we will explain here until you reach the consistency. History of the market. It would be unacademic to start this master without knowing the history of the market, so we will make a quick visit to its history that will allow us to understand how the market currently works, and how human psychology has influenced the development of it. The history of the financial market or trading is a story of bubbles. The most popular historical bubbles are the Tulip Mania in 1637. The bubble of the South Sea Company, 1711 to 1720. Crack of the stock market of the United States in 1929. The history of the Hunt brothers, 1970 to 1980. Michael Milken, the king of junk bonds, 1970 to 1980. The history of Longterm Capital, 1994 to 1998. The Enron case, 1985 to 2001. The fraud of the Brex Mining Company, 1995 to 1997. Bankruptcy of Barings Bank, 1995. The Internet bubble in the Nasdaq, 1997 to 2000. The Madoff bubble, 2008. In the book of the course we explain in depth each of them. We pray you to study them carefully so that you can understand correctly how they were formed, how they exploded, and what their effects were. In this video we will make a succinct description of them. The Tulip Mania, 1637. The Tulipomania or bubble of the tulips was a period of a speculative euphoria that took place in the Netherlands in century 17. The object of speculation were the tulip bulbs, whose price reached exorbitant levels, giving rise to a large economic bubble and a deep financial crisis. At the same time, and for reasons that were unknown at that time, the tulips grown in Holland suffered variations in their appearance, thus giving rise to multicolored, unrepeatable tulips, which increased their exoticism and therefore their price. Today it is known that the cause of this phenomenon was a parasite of the flower, the aphid, which transmits a virus to the plant. A single tulip bulb came to be sold for the price equivalent to 24 tons of wheat. In 1637. On February 5, a bundle of 99 tulips of great rarity was sold for 90,000 florins. It was the last big sale of tulips. The next day a small lot of half kilo for 1,250 florins was tried to sale, and for no apparent reason, the lot was relegated because no buyer. From this moment the news spread like wildfire and the bubble burst. It constitutes one of the first speculative phenomena of masses of which one it is news. South Sea Company, 1711 to 1720. It is known as the bubble of the South Sea to a speculative bubble that occurred in Britain in the early 18th century, and that led to the so-called crack of 1720. The speculative bubble occurred around the actions of the South Sea Company, international trade company, that held a monopoly of British trade with the Spanish colonies of South America, and the West Indies. At the beginning of August 1720 the quotation reached £1,000, and the trend changed sharply. Mainly because of the obvious exhaustion of the economic resources of most small savers to be able to acquire shares. £1,000 of that then were equivalent to almost £1 million of the year 2000. When investors became aware that the promises of business opportunities were no longer seen as achievable, the speculative bubble exploded. The crisis spread to the English banks, many of which had borrowed heavily to acquire and speculate with the shares, which produced a sudden number of commercial bankruptcies. Crack of the stock market of 1929. The crash of the 29 was the most devastating fall of the stock market in the history of the financial markets in the United States, taking into consideration the global reach and the long duration of its sequels, and whose consequences were the 1929 crisis, also known as the Great Depression. The crash of the 29 was preceded by a speculative boom that had emerged in the early 1920s, and had led hundreds of thousands of Americans to invest heavily in the stock market. Even a significant number of them were lent money to buy more shares. The euphoria and financial gains of the great market trend were shattered on October 24, 1929, called Black Thursday, when the value of the stock on the New York Stock Exchange plummeted. Stock prices fell that day and continued to fall at an unprecedented rate for a whole month. 100,000 U.S. workers lost their jobs in a 3-day period. This situation did not end until 1932, when the Dow Jones closed at 41.22 on July 8, ending this crisis period with a deterioration of the Dow Jones index of 89% with respect to the highest level previously reached by this index. The Hunt Brothers, 1970 to 1980. The Hunt family was one of the richest families in the US in the early 70s, and certainly the most important in the state of Texas. The 70s were years of war in the oil sector, and therefore of inflationary tensions. The investors of the time invested their savings in the markets of precious metals, excluding gold that at that time could not be in the hands of private investors. In 1979, the Hunt brothers along with some Arab investors decided to form the so-called pool of silver. In a short time they had accumulated directly, or indirectly under their control about 200 million ounces of silver, approximately 77% of the world available silver reserves. The Hunt brothers had bought more silver than there was in the world. Suddenly the American government found itself between a rock and a hard place. Either save the Hunt brothers or rescue the Wall Street banks and the futures market. Then Wall Street was positioned against the silver, and on Thursday, March 27, 1980, known as the Thursday of the Silver, the price plummeted 50%, going from $21.62 to $10.80 an ounce. The Hunts were sunk. They had to declare bankruptcy, were prosecuted, and convicted for manipulating the market price. Michael Milken, Junk Bonds, 1970 to 1980. Milken successfully tried to break the traditional bond market that was only intended for companies with high ratings, issuing debt from a small company that was at risk of bankruptcy. He discovered a large untapped niche market. Milken thought that if many small companies issued bonds, and the institutional investor took positions in many of them, his risk of bankruptcy would be minimized, some would fall, but the high interest rate that he received in return would more than compensate him. However, all that began to deteriorate when a series of unscrupulous investors came into action. They needed a lot of money to devour other companies, most of the time for totally speculative purposes. The procedure was the same as always. They were going to Milken asking for astronomical amounts for which they were willing to pay high interest rates. Once the money was obtained, they presented a hostile takeover bid against companies that could not withstand the avalanche, creating chaos in a multitude of companies. This type of operations was reaping to Milken without knowing its future possibilities of business, and in the long run, it would be the ones that would cause the fall of this man who was immensely rich. In 1990, Milken's firm had no choice but to declare bankruptcy in an uncontrolled chaos. Longterm Capital, 1994 to 1998. John Meriwether, Vice President of Solomon Brothers, and one of the most famous managers among brokers around the world, decided to create the hedge fund and apply the theory of the convergent trade in an investment fund destined to the greatest fortunes of the planet, the Long-Term Capital Fund. Its initial capital was $1,011 million contributed by 80 VIP investors. The Long-Term Capital Fund speculated with all types of bonds and fixed income, through a long-short style that had unstoppable initial effects. In its first 2 years of life, the hedge fund reached annual returns close to 40%. Investors began to lose their fear because of the excessive leverage used by the managers of the fund, and the truth is that the results did nothing but make them right. The increase in credit spreads, mortgage debt, and the economic crisis in Russia brought fear to investors around the world, and marked the beginning of the end for the Long-Term Capital Fund. The situation became so chaotic that, in September 1998, the hedge fund managed $1,000 million, but had a debt of $100,000 million. Only 2 years later, the Long-Term Capital Fund was liquidated. The Enron case, 1985 to 2001. Enron Corporation was an energy company based in Houston, Texas that employed more than 21,000 people by mid-2001. However, the reputation of this company began to decline due to the insistent rumors of bribery and influence peddling to obtain contracts in Central America, South America, Africa, the Philippines and India. Simultaneously, a series of fraudulent accounting techniques, backed by its auditing company, the old prestigious firm Arthur Andersen, allowed to create the biggest business fraud known until then. In August 2000 the company reached its zenith, achieving a price of $90.56 per share. However, once the year 2001 began, the company's shares on Wall Street began to fall quickly from $85 to $30, when rumors emerged that Enron's profits were the result of business with its own subsidiaries. This practice it allowed him to make up the gigantic losses he had suffered in recent years. Enron applied for bankruptcy protection in Europe on November 30, and in the United States on December 2, 2001. On May 25, 2006, Kenneth Lay, president of Enron, and Jeffrey Sking, his former executive director, were convicted of conspiracy to commit frauds. The mining company Brex, 1995 to 1997. The Brex Mining Company was a small and insignificant mining company in Canada, owned by a former exchange agent named David Walsh, who made public the news that he had discovered a large gold deposit in Buzanley, on the island of Borneo. Walsh not only had invented the news, but exaggerated it to the point of ridicule, saying that the discovered field contained 8% of the world's gold reserves, in total 6,500 tons. To demonstrate the truth of his discovery, he showed samples that consisted of vulgar stones from the area to which artificial remains of gold had been added from other places. In addition, through payments and commissions, he got the Indonesian government to confirm the deposit. On May 6, 1997, independent auditing technicians determined that the site that purported to be the largest gold discovery in history is practically a piece of land without value in the middle of the Borneo jungle. That same day, in the Toronto Stock Exchange, Brex plummeted more than 97% in less than 10 minutes. And what used to be worth $6,000 million was reduced to a scant $10 million. Walsh escaped to his property in the Bahamas, where he took refuge from justice and the vice president, to the Cayman Islands. The bankruptcy of Barings Bank, 1995. Barings Bank, from 1762 to 1995, was the oldest commercial banking company in London until its collapse in 1995 after one of the employees, Nick Leeson, lost £827 million, approximately $1,200 million in 1995, essentially speculating on futures contracts. Everything starts when Leeson falsified the accounting for a few thousand sterling pounds to cover the mistake of an employee, who for humanity he does not want to fire. Then, bit by bit, the pressure was so great that the errors of the operators of his team follow one to another, and he continues using the falsification of the accounting to cover them. The balance of the falsified accounts continues to grow, and Leeson begins to operate to recover. Little by little the figure is astronomical. On February 1995, Leeson's activities had generated massive losses totaling £827 million, $1.2 billion, twice the bank's available capital. The Bank of England tried a rescue over the weekend, but it was unsuccessful. Barings Bank was declared insolvent on February 26, 1995. The collapse was dramatic, having been suddenly retained the bonuses of its employees in the world. The losses of its shareholders and customers were dramatic. Nick Leeson fled Singapore but was arrested in Germany and extradited back to Singapore, where he was convicted of fraud and imprisoned for 6 years. Internet bubble in Nasdaq, 1997 to 2000. The Internet bubble or dot-com bubble is a term that refers to a period of growth in the economic values of companies linked to the Internet. This enormous speculative economic current developed between 1997 and 2001. During this period, the stock exchanges of Western nations saw a rapid increase in their value, due to the advance of companies linked to the new Internet sector, and the so-called new Internet economy. Over time, many of these companies went bankrupt or stopped operating. As in all bubbles, there is always a maximum highlight. This was in March 2000, after reaching the Nasdaq index raised 5,132 points. From this moment the bubble starts to deflate, and it is in 2001 when it deflates at full speed. Most of the dot-com companies ceased their activities when they did not obtain benefits, and they no longer had more financing. In total, the dot-com boom caused $5 trillion in value losses from technology companies, from March 2000 to October 2002, and in summary, millions of ruined investors. Madoff bubble, 2008. Madoff begins to see the opportunity of business investment advice, and in the 60s he founded a financial coverage fund. The idea of creating a financial coverage fund is not qualified as a scam, but the way in which Madoff captured the investments and distributed the returns. Madoff was part of the most respected Wall Street investors. He even became the president of the Nasdaq. He was a kind of guide and guru of businessmen for the world of finance. The logic followed by Madoff was simple, and at the same time deceptive to his clients. Thus, new clients paid the expected returns of the old ones. This system is a gold mine as long as there are new victims to cheat, who enter the game, are ambitious, and expect high returns in the short term. Madoff's scam was uncovered due to the global economic and financial crisis of 2008. Many investors began to demand the return of their money, and this caused the collapse of the system. On December 11, 2008, Bernard Madoff is arrested, and he declares that the fund he administered was a fraud, and that the losses amounted to approximately $50,000 million. Market terms. Although we will try during the development of the courses, to use a colloquial language, and easy to understand by any student, sometimes some terms that you may not know will appear. For this reason, we have prepared a dictionary of market terms. You do not need to study it, simply use it as a reference guide. When you do not understand, or do not know any term that we use during the courses, this dictionary is part of the complimentary course content. We pray you to download it from the complimentary content page of the courses, as well as the course book, and exercises from our website. Conclusions. The market is a bubble's achievement. Therefore, we must be very aware of the evolution of the price movement. We can never establish the considerations of the type, the price is very cheap, or the price is very expensive, when we decide to enter in the market. We must always operate together with the trend. Opening operations against the tendency only entails the loss of our money. You must eradicate the nerves, and the greed, of your trading equation. If you do not do it, you will never reach consistency in the trading process. Trading when you are consistent is downright easy. However, in these moments, a long way to reach consistency awaits you. Be patient, you will reach it, if you follow our instructions accurately. The only thing that you must be worried now, is about to control your emotions, limit your risk to the maximum value of 5%, and not broke any rules, golden rules. Based on the concepts established in this course, we can determine the following golden rules. Keeping open operations for a long period of time in the market, inexorably leads to an excessive risk that our account cannot support. An abrupt variation in the movement of a price can mean losing all our money to the maintenance of excessive risk. If we have opened a position in the market, and it does not evolve favorably, it is mandatory to close it immediately. The rules that govern the trading process are established to comply with them. Its non-compliance inexorably leads to the loss of your money. Remember always, only we are responsible for our actions. Exercises of the course. Each course consists of 4 evaluation exercises. No questions will be answered, nor will there be any evaluation, if the student is not correctly enrolled in the master, and if he has not paid the exam fees. Course exercises. Exercise 1. Look for a stock that has suffered an economic bubble, not mentioned in this course, and explain what it consisted of, how it was formed, how long it lasted, and the consequences that this bubble caused in the market. Exercise 2. Represents the movement of the stock price during the economic bubble, and explains the graph. It includes the most relevant economic news, and explains how they influenced the price movement. Exercise 3. Establish the golden rules of action that you consider appropriate before this economic bubble and justify them. Exercise 4. Explain how you would have acted with this stock in the market during the economic bubble period. Represent your entries and exits from the market in the previous graphic. Farewell. So far the first course of the Master. Market History. This course is part of the Professional Trading Master courses, aimed at new traders, developed especially for you. I hope that the information that we have transmitted to you is of your interest. Do not hesitate to inform you about the rest of the courses on our website. I wait for you in the next video of this exciting master. Until then, we wish you a happy trading.